Is a stock market crash on the horizon? The Dow fell more than 900 points last week as the news of a new coronavirus variant came out that it could derail the growing economy. Actually, last week started with positive news about the labor market and the big consumer spending for the Black Friday. The consumers were expected to spend a record amount of dollars on the Black Friday. The travel was looking like it was returning to the pre-pandemic levels. Then the news of the new Omicron variant came out. The Dow, Nasdaq and S&P 500 shared about 2.5% last week. The investors are adopting a sell first and think later mentality. The bond prices rose and the yields tumble. The bond price and the yield go in inverse direction. As investors fear the economic outlook, they start purchasing the bond, sending the yields down. Is such a panic warranted at this juncture? The investors are getting tired of a long stretch bull market, and every negative news that pops up now and then spooks them. In this video, let us analyze holistically the current economic outlook. I will start with a technical analysis of the Nasdaq 100, S&P 500, Dow Jones and the Bitcoin. Then we will look at the various fear gauges of the stock market like the CBOE Volatility Index, the VIX, and the CBOE put call ratio. My name is Arshad Ahmed. I'm founder of DIYstockpicker.com, an investment portal dedicated to help investors make intelligent decisions. This video is for informational purposes, and please do your due diligence before making any investment decisions. If you are new here to this channel, hit the subscribe button. I have spent more than 8 hours analyzing the current economic outlook and presenting it to you, so please stay until the end. And I'm sure you'll find this very informative. So let's get started. Let's start with the technical analysis of the Nasdaq 100. We are looking at the weekly chart here. The overall trend of the Nasdaq 100 is positive. There have been corrections as much as 10 to 15% every now and then. Dusting off these, the index keeps moving higher. There is a support level at around 15,700 points. This was the resistance in the previous uptrend. Breaking this level, the index charged further. It is now coming back and testing this level. If the market opens, and then we may see a formation of a head and shoulder pattern. After forming the shoulder, if the index moves up again, then the previous all-time high can easily be broken. If the index breaks the 15,700 support level, the next support on the weekly chart is at the 14,100 level. Let us look at the weekly chart for the S&P 500. The S&P 500 is having a dream run so far. The index has returned more than 22% this year so far. On the weekly chart, there is a strong support level at 4535 points. If the index breaks the 4535 support level, the next support on the weekly chart is at the 4270 level. There is a double top formed on the chart, which should have given a signal that a correction is near. The buyers were losing steam and sellers seems to be stepping in. There will be resistance at the 4600 level, and the index has to break through this level before the buyers will step in. Let us look at the weekly chart for the Dow Jones. The Dow Jones Industrial is on an upward trajectory. The trend line had been tested about 8 weeks ago, but the index bounced back. This instance, it seemed to have broken the trend line. The buyers are getting exhausted in the market. There is a strong support level at 33,670 points. The 35,670 may act like a strong resistance. To summarize, we may see some consolidation of the price action between 33,670 and 35,670 points. This is a channel of 2,000 points wide. This may be an ideal market condition for option sellers who can sell calls about 35,670 and puts below 33,670 and make money. Now let us analyze an important asset class, which is the Bitcoin. After the huge breakthrough of price, Bitcoin has been trading sideways for the past few weeks. The 53,000 level had been tested twice and the price bounced back. If the buyers step in now, there will be major resistance at the 60k level again. If the 53k level is broken, there is not much support until the 40k level. A double top has been formed at all-time highs and the price is looking like an M pattern. This is a bearish pattern and there may be headwinds ahead for the Bitcoin. We are looking at the market sentiment index. This index shows extreme fear at the moment. There are 7 gauges that are used to arrive at this sentiment. I'll go through a couple of them here. Let us start by taking a look at the volatility index, the VIX. VIX is a contrarian indicator that indicates the market sentiment among the big institutional players. Now, traditionally, the small investors try to emulate the big institution investors. Before they make positions, they try to get in a stock and they try to come out before the big institutions dump these shares. But the point to note is that big institutions purchase in billions of dollars of shares, so they just cannot dump a position and get out. For this reason, the institutions always look to hedge their portfolios, and they do this by purchasing put option contracts. Let's very quickly go through what a put contract does. Say there is a stock that is trading at $100 a share, and there is a put with a strike of $105 that is trading at $7. Each put gives the owner of the put the right to sell the 100 shares at the strike price. So the owner of the $105 put can sell 100 shares at $105. Now the value of the put is $7. In that, the $5 is the equity value, which is called the intrinsic value, and the $2 is the extrinsic value. This extrinsic value consists of the time premium and the implied volatility. The VIX indicator is actually a measure of this implied volatility, the extrinsic value of the option contracts. Now VIX measures the implied volatility of the S&P index options. These index options have very high strike prices and high premiums, so retail investors usually do not trade these option contracts. These option contracts are for institutional investors like pension funds. Even the traders who trade them are big institutions. So the implied volatility among these contracts gives an idea of how the big institutions are hedging their portfolios. A general rule of thumb is, if the VIX is high, it may be the time to buy, and if the VIX drops, it may be a time to sell. The CBOE Volatility Index VIX is at 2862, 54% above its 50-day moving average, and indicates that investors are concerned about the near-term values of their portfolios. The other market gauge is the CBOE put call ratio. 90% of the people who buy options lose their money. The put to call ratio indicates how many people are buying options, the put options, and how many people are buying the call options. Now this indicator can be used to gauge the market sentiment from a retail investor perspective. The earlier VIX gives us an idea of the institutional investors, whereas the put call ratio gives an idea of the general investors. If the put to call ratio is high, that indicates that people are buying more put options than the call options. So the retail public is thinking that the market will go down. In this case, it may be a good idea to actually buy stocks because they will go up. Whereas if the put to call ratio is low, it indicates that the public are buying the call options more than the put options. This happened during the tech crash of 2000. The people were buying call options so much that the put to call ratio decreased. At this instance, the market crashed. So the put to call ratio indicator indicates the general market sentiment and may give buy sell signals to the investors. During the last 5 trading days, volume in put options has lagged volume in call options by 54%. This means that investors are making bullish bets in their portfolios. However, this is still among the highest levels of put buying seen in the last 2 years, indicating fear on the part of investors. To conclude, the Federal Reserve took decisive action when the pandemic started. They started a huge bond buying program and also brought down the interest rates to zero. The Fed purchased $120 billion of treasury yields and mortgage-backed securities each month. Now that the economy is recovered, the Fed was looking to raise the interest rates to cool down the inflation and also taper the bond buying program. Now the news of the Omicron variant have surfaced. This may lead the Fed to delay its tapering and also delay the raising of interest rates. The Fed is behind the market with an iron fist, and they want to make sure that the mistakes made during the 2008 recession are not repeated. Now, to answer the question that is a stock market crash on the horizon, the answer may be no. But we may see a correction in the stock market which is healthy for the long run. But as investors, it is our responsibility to know the various macroeconomic indicators and keep an eye on them, that we follow the signals that these indicators give us. I hope you found the video informational. I'll be releasing videos weekly. If you're new here, I'll really appreciate if you can subscribe and like this video and share with your families and friends. And I hope to see you in the next video. Thanks for watching.